Welcome everyone to the Firing the Man podcast. Today we interview Josh Bauerle, who is a CPA and the founder of CPA On Fire. Josh is a specialized tax accountant for e-commerce entrepreneurs, and we had an excellent conversation with him. Ken, what did you think about the conversation?
Yeah, the interview we just did with Josh is crushed it, man. I'm super excited to bring that to the listeners. Josh covered so many topics that are complex. It's tough to understand, and he just kind of simplified it all. And he covered PPP and EIDL and tax implications of those, and just so many other topics.
Yeah, I would say that one thing that Josh does an exceptional job of is making really complicated topics easy to understand. For instance, we went down a rabbit hole on sales tax and specifically collecting sales tax on Amazon, and he provided some really good explanation there. He also had some great comments on extracting money out of your business, either through a salary or a bonus. And lastly, he talked about sole proprietorship versus a partnership versus an LLC versus an S-Corp, and which one of those entities makes sense for what type of entrepreneur. And so, yeah, this was an excellent episode, and really think the listeners are going to enjoy it. All right, welcome everyone to the Firing the Man podcast. Today we're joined by Josh Bauerle. Josh, welcome to the show.
Hey, thanks for having me.
Absolutely. I think first things first, tell us a little bit about yourself.
Sure. I'm a CPA. I founded a tax business called CPA On Fire. We work primarily with online entrepreneurs, so a lot of e-commerce sellers, podcasters, bloggers, basically anyone who makes their living entirely online. I spent a lot of years working in CPA firms and financial advising firms, and the big thing I saw at that time was that there was a lot of small business owners who weren't being serviced properly. They were kind of stuck in between of going to like a chain shop where they got no help or having to pay crazy fees to big time CPA firms where they're kind of just the low man on the totem pole that wasn't paying the $100,000 a year fees and just kind of still getting basic service. So I saw a need there and kind of started a business that would target these people and give them the help they needed. And it took off pretty big from there. And now we work with a lot of the bigger names in the online world.
Very nice. Very nice. Now, what prompted that? Were you an online seller as well, or why did you decide to get into this niche?
Yeah. So I really didn't even know much about the online entrepreneurial world at that time. I knew I wanted to work with small business owners, so that was the first thing. But early on, I listened to a podcast called Entrepreneur on Fire, where he was just interviewing online business owners. And I reached out to him. I was like, hey, I'm a CPA. I have my own tax business. If you ever need a guest on your Entrepreneur on Fire podcast, I'd love to come on. And he's like, hey, I don't need a guest, but I do need a CPA. So I started working with him, and his podcast blew up really quickly, and he started having me on once a month to do a tax tip. And that's just kind of how the niche formed naturally from there. I became the guy that worked with online based businesses. So it's kind of coincidental and a little bit of luck, but it worked out well.
Well, a lot of our listeners are either have an existing e-commerce company or are just starting a e-commerce company. And so I would say early on in that growth stage, taxes are not on people's mind. And so what would you say in terms of just getting yourself set up right? What are some considerations that someone should take when they're starting their business to set them up for good tax strategy?
Yeah, and I would say I see a lot of people in two different camps. There are people who aren't concerned enough about taxes when they start up, or people who are overly concerned and don't even get started because I got to figure out all this tax stuff. So I think the proper balance is somewhere in between. Know that taxes are going to be a thing with your business, but don't not get started because you're worried about optimizing that. A few things to keep in mind right from the start. The biggest thing to me by far is you have to have some type of accounting system. So you're recording that income coming in, those expenses going out. It can be as basic as a spreadsheet that you're recording everything. Personally, I can tell you that any tax preparer you use is going to prefer that you use some type of accounting software, whether it's Xero, QuickBooks Online, Wave, GoDaddy. There's a million options out there. I'd suggest using one that's cloud-based, and it just makes your life easier. But my biggest advice right from the start, get something in place so you're recording everything that goes in and out of your business. On top of that, set up separate accounts. That's going to make that recording even easier, right? Don't use your personal bank to be buying the stuff you're needing to get this business started, and don't use that to have the money come in. Have these separate accounts so that you know everything that goes in and out of that account is a business transaction. It's going to make your bookkeeping easier. It's going to make it easier if the IRS ever asks questions. It's going to protect you legally if you ever form an LLC. So keep those separate accounts. And finally, somewhere early on, start to get some type of business entity, whether it's an LLC, whether once you start making some money, LLC taxes and S-Corp, but look into it, figure out what the right one is for you, figure out what type of legal liability protection you need, figure out where you're at tax-wise, and get some type of entity set up.
Yeah, I'm glad that you brought up the legal entity, and if we could dive into that a little bit more for those who are unfamiliar. So to me, it seems like there's 3 routes. Tell me if I'm wrong. The first being sole proprietorship, second LLC, and 3 S-Corp. Is that right?
Yeah, absolutely. Those are the 3. And I guess if you wanted to add one, the equivalent to the sole proprietor, if you have a partner, just be a general partnership, which is the same as a sole proprietor, but you have a partner. So,
okay. Can you walk through each one of those and talk about which one might be a good fit for what type of person?
Sure. So a sole proprietor or a general partnership, if you have a partner, basically you're not doing anything to set up an entity. You're just hitting the ground running. You're saying, I'm setting up my account on Amazon, whatever. I'm going to start selling. I'm going to start making money. And it's totally fine. You can absolutely do that. Some people think they have to have an entity or get some type of business license to get started. And that's not the case. If you just want to go, you have an idea, you're ready, you want to hit the ground running, you can do that. You can have a sole proprietor. For tax purposes, it basically treats you and the business as one and the same. All right, so it's going to get reported directly on your personal tax return as a Schedule C. Legally, there is 0 legal protection. You and the business are, again, one and the same. So and I'm not an attorney, so I'm just going to go over basics here, but in theory, someone sues the business, they're suing you personally. So that's generally the drawback with the sole proprietorship, is you have personal exposure legally. The next step up is the LLC. And a lot of people are surprised to learn the LLC actually offers 0 tax benefits. It's the exact same thing as a sole proprietor when it comes to taxes, right? The IRS calls an LLC a disregarded entity. So if you form that LLC and you're the only owner, it's going to be treated exactly the same as when you're a sole proprietor. It's going to be on your personal return, on your Schedule C. The difference is it offers that wall of protection between you and the business. So you have your business here, you have you personally here, and there's a wall in between that. In theory, someone can sue the business and not get your personal assets. And again, talk to an attorney. There's always exceptions to those rules. There's a lot of ifs and ands and buts involved in the LLC, but that's the general reason to form an LLC, is to offer you some type of legal protection. The next step up from there would be to have your LLC and elect to have it taxed as an S corporation. And that's where the tax benefits come in. So it's, again, what they call a pass-through entity, meaning those profits are recorded on your personal tax return, but it can save you quite a bit in taxes once you start seeing some serious profits in your business. So those are the general differences. There's a lot of nuances in between, but that's the general scope of it.
Okay. Is there a point at which it makes sense to transition from an LLC to an S-Corp?
Yeah. So we used to say once you start profiting, meaning after you take in all your income, you deduct all your expenses, what's left is your profit. Once that profit hits the 40 to 50,000 range, an S-Corp is a no-brainer. That's changed a little bit with some of the new tax laws and the QBI deduction, which we can talk about. I would say now it's more in the $60,000 to $75,000 per year range in profits when that starts to make sense. There's always, you want to look at it individually. If you have a day job and you make a high wage in your W-2 job, then an S-Corp may not make sense until much later. But generally speaking, for most people, the $60,000 to $75,000 per year profit range is when an S-Corp starts to make sense.
Okay. And you mentioned QBI. Let's jump right into that.
Yeah. So that was part of the new tax code in 2018, the qualified business income deduction. And the way this works, and again, this for people just getting started, this is confusing, because I hear people all the time saying, hey, I have this business, it made $100,000, but I didn't touch any of it. I left it all in the business, so I don't have to pay taxes on it. That's not the way it works. All right. The IRS is going to say, I don't care whether you took all of it out, left all of it in, you're going to pay taxes on 100% of that income. So if you profited $100,000 and you left all $100,000 in that business account and didn't touch it personally, you're still personally going to pay taxes on $100,000. What the QBI did in 2018 is said, all right, instead of paying taxes on 100%, you're going to pay taxes on 80%. So it's an automatic 20% deduction. So you profit $100,000, you're only going to pay taxes on $80,000, which is a huge deal. That saved a lot of entrepreneurs quite a bit of money.
Okay, so that is in the QBI, that is applicable to an S-Corp or
any pass-through entity. So any of the three options we talked about is going to have access to that deduction.
Okay, very nice. Yesterday, for episode 33 of the Firing the Man podcast, we had Anna Hill from Accounting We Will Go. And she talked a little bit about cash basis accounting versus accrual basis accounting, and gave us some kind of an overview on the bookkeeping side. And one thing that I think most people would agree is if you can avoid paying taxes, then do it, right? And so say you do have that business, and I know I've run into this where I've built and grown a business for 2 or 3 years before ever drawing an income. But say you are showing, at the end of November, you're showing $60,000 in profit. And you're not planning on drawing any of that income for, say a personal salary. Is there anything that you can do, say like buy $60,000 worth of inventory that would lower your tax burden?
So that's a big issue in the e-commerce world. You can buy $60,000 worth of inventory, but you will not get a $60,000 deduction for that, because you can only deduct the inventory that's actually been sold at the end of the year. And we have a lot of e-commerce people get tripped up on that. They do exactly what you said. They think, all right, I have this money. I'm not going to take it out personally. Let's lower my tax bill. I'm going to need inventory eventually anyways. Let's just buy a bunch of inventory. Now they find out at the end of the year, they don't get a deduction for that. You only can deduct what you actually sold during the year. And now they kind of used up the cash that they'll still need to pay taxes. So there are certainly things you can do that for. Let's say that maybe you do a lot of pickup and deliveries for your e-commerce business, right? And you need a new truck to do that. You could go buy a new truck, and that could drastically reduce your tax bill. You could buy a new computer for your business. There's a ton of things you can buy that you're using in your business that would reduce that tax bill, but inventory is not one of them. And that's a key thing that people have to know early on, or they can get themselves in a cash pinch.
So Josh, and we're talking about reducing taxes. What are some of the top 2 or 3 ways that you've seen recently that are working in the e-com space to minimize the tax liability?
Yeah. So number one, once they become profitable, the number one thing you can do is form that S-Corp once you get to that range. That can easily reduce your tax bill $10,000 or more once you start getting pretty high profits. So pay attention to that, know where your profits are, and know when to pull the trigger on that S corporation. Number 2 is making sure you're maximizing that QBI deduction we talked about. So there's some, as with anything tax related, there's some nuances in that. And if you end up getting too high income as a sole proprietor, you may phase out of that QBI. So you needed to make an S-Corp election. If you're an S-Corp, you could phase out of it if you're not paying high enough salaries to employees. So it is a basic deduction, that 20%, but there's a lot of things that go into it. So you need to make sure you're maximizing that, and you know what you need to do to maximize it. And number 3, I think it's really just knowing what you can and can't deduct, right? So knowing that if you have a home office, you can deduct a home office and what goes into that home office. Knowing that if you need a computer in your business, you can buy a computer and deduct it, even if you're maybe using it some personally. Cell phone, internet, all this stuff that you use personally could be a partial or full deduction if you're using it in the business and if you know how to do it properly.
Now, on that S-Corp election, is that something that you need to do at the beginning of the tax year? Is that something that you can apply for mid-year? How does that work?
Good question. So there is a technical deadline of March 15th that you need to make it. So if you want to do it for the 2020 tax year, technically you'd have to do it by March 15th. But they have a late election allowance that basically if you elect it, let's say in November, and you say you want to do it for 2020, all you have to do is say, I meet all requirements of the S corporation, except I didn't elect it on time. I didn't know I needed to fill out this form, basically plead ignorance. We've had 100% success rate, and we do this at least 50 times a year. So I've personally never seen it rejected. And the key there is you don't want to do this too early. So unless you've already hit that profit level before the year, there's benefit to waiting until later in the year to do it, to make sure you're going to hit the profit level where it makes sense. So I personally wouldn't be afraid to wait until later in the year and make that election. I've never seen it not be successful when done properly.
Okay. A lot of our listeners, the path that they follow is they will have a W-2 job. And from a tax standpoint, that's very convenient, where taxes are taken out of your paycheck. And then usually at the end of the year, you file your return. And depending on how many allowances you have and other situations, you either get a small refund or small return. Pretty easy. Now, some of those listeners will do very well in their e-commerce business. They will fire the man, get rid of that W-2 job, and they are now, either operating in an S-Corp or an LLC, and it's not as convenient, right? And so can you talk about making estimated tax payments versus waiting till the end of the year, and any planning that someone can do on the front end of firing the man, just to set them up for no surprises at the end of their first tax year?
Yeah, so a couple things with estimated payments. Number one, they're really intimidating to people because they think that estimated payments mean you have to file some type of form or return every quarter with the IRS. It's nothing you're filing with the IRS. You don't have to do a return every quarter. All you're doing is making a payment to them each quarter. So it's not near as difficult as it sounds. Number two, what you have to pay in quarterly to avoid any type of penalty is based strictly on what you had to pay the year before. So if it's your first year making a profit, you probably don't even have to make those estimated payments. Now, you still want to save the money, right? Because you don't want to get to the end of the year and owe taxes and not have the money to pay it. But you don't have to pay them in if you didn't owe the year before. Okay. And number three, the biggest thing you have to do is set aside that money so it's ready to pay. And I know it's confusing to know how much to do. I would say start with a minimum of 25% of your profits. Okay, so if you made $100,000, set aside $25,000 to be ready for those taxes. That'll put you in pretty good shape.
Nice. That's a good ballpark figure to aim at. So I want to switch directions a little bit and get into a topic that's kind of recent this year: the PPP and the EIDL. So those are recent programs government released for due to the pandemic and the economy. Now, are there any? Can you discuss any like tax implications for those programs, or what's upcoming on those?
Yeah. So PPP, the Payroll Protection Program, that's the big one. That's a 100% grant if you use it properly, meaning you never have to pay it back. All right. And how much you got depended on what type of entity you were. If you were a sole proprietor, it's based on your profits the previous year. If you're an S-Corp, it's based on the salaries you pay yourself and your employees. But the key is you never have to pay that back as long as you use it for qualified expenses. And there's that what's qualified expenses is still evolving, but it's mostly going to come down to, if you're an S-Corp, it's going to come down to your payroll. How much are you paying yourself in salary? How much are you paying your employees in salary? On top of that, you can pay rent, you can pay your mortgage interest if you have a building that you're using for the business. There's a few other qualified expenses. Now that they've extended it out, originally they said you had to spend all that money in 8 weeks. Now they've extended it out to 24 weeks. There's really no reason anyone shouldn't be able to qualify now. But you just have to make sure, especially if you're an S-Corp, you're spending all that money on salaries for you and your employees. But if you do that, you never have to pay it back, and it's not taxable income. So it's basically free money from the government. And I know that's scary to hear. Everyone says there's no such thing as free money, especially from the government. But in this case, it's the truth. If you spend it properly, you will never have to pay it back. It will not be taxable income. EIDL. So there's two components of EIDL. There's the grant portion. All right. So for those who have already applied, if you're a sole proprietor, you just got a flat $1,000 grant. If you have employees, if you're an S-Corp or have employees, you get $1,000 per employee, up to $10,000 total. Right. That portion is a grant. Never has to be paid back. Nothing special you have to do with it. not taxable income. All right. So it's like PPP. It's just free money that you never have to pay back. On top of that, they offered a lot of people a loan. All right. That again is not taxable income, but you do have to pay it back. And they should have went over the terms when you signed up for it of what that payback is. It's delayed for 12 months. You won't have to make a payment for 12 months, but that will be eventually paid back unless somewhere down the line they scratch it and say everyone's forgiven. But as of now, you have to.
We can hope for that, right?
We can hope. Yeah, I mean, and at this rate, who knows? But
right. Every few months it changes, it seems like.
In terms of other programs or other thoughts or considerations surrounding this pandemic and some of the government funding programs, is there anything else entrepreneurs should be thinking about aside from the EIDL and PPP loan?
Yeah, so those are the two big programs right now. The only other thing I would say is a lot of entrepreneurs didn't know that if they've had a huge impact from the business and they're not making any or as much money, they can apply for unemployment, which hasn't been the case in the past. So as a business owner, you can apply for unemployment, and for at least a little while longer, you get not only the state unemployment but the federal unemployment, which is an additional $600 per week. So you can get quite a bit of money on unemployment right now if your business has had a big impact from the pandemic.
Okay. And I think we're going to see that in the e-commerce space at the time that we're recording this episode. It is July 16th. And this week, Amazon made a big announcement on the amount of inventory that we'll be able to send into warehouses in Q4, which at the beginning of this pandemic, I know personally this caused some serious issues in my business, and hoping to play my cards a little bit differently in Q4, but I still anticipate this causing some issues. So yeah, it'll be good to keep an eye out for that. What are you seeing in terms of some of your e-commerce clients? How are they weathering this storm?
Yeah, it's tough. Everyone tells you as an entrepreneur, you need to be prepared and have stuff saved for a rainy day, but I don't think anyone ever prepares for a pandemic and a total global shutdown. As far as impact, it's been all over the board. We have some clients that are completely unimpacted and some that have been shut down through no fault of their own. And I mean, obviously a lot of it depends on what you're selling, who your market is, what platforms you're using, but it's tough. And I think the only thing that we tell our clients is just remember what made you successful as an entrepreneur. Is that to be a successful entrepreneur, you have to be perseverant. You have to persevere. You're going to hit obstacles. You're the kind of person that made things happen. That's what's going to get through this. You got to have patience. You got to have perseverance. You got to tap into every resource you have available. You got to know what these government programs are, how much you have access to. You got to get your hands on any bit of money that you can. Cash is huge right now. Any type of cash reserves you have are huge. And it's just, what's the next right thing to do day by day?
Yeah, that's good. So Josh, it kind of brings me into my next question for you. So in terms of just entrepreneurs just kind of grinding it out. So David and I have been focusing on expanding into other sales channels, eBay, Etsy, Walmart. Now I want to switch directions a little bit and go into sales tax and Nexus. So I know it's kind of it's a fun one, and it's one that, I'm not a CPA like you and David, so I'm like, what's going on here? But so now, a couple of my brands are selling on 3 different channels now. Can you explain Nexus, sales tax, and what's the current state of what's going on there?
Yeah, the current state is chaos. We'll start there. Let's start with Nexus. Nexus simply means that you have some type of physical presence in a state, which is going to require you to collect and pay sales tax to that state. And for most people, for most businesses, this doesn't become an issue because, they'll say I start a business in my town of Willard, Ohio, all right, and I'm doing taxes for people. I don't open an office in any other state. I don't have any type of physical presence there. But once it comes to e-commerce, especially for like Amazon sellers, fulfilled by Amazon, when you put inventory in that state, most states consider that Nexus because you have physical presence in the form of your inventory. And like Amazon, you don't have any control. You can't say, just keep it in Ohio so I don't have Nexus in anywhere else. They're going to put it all over the country. Are they in every state? I know that last I heard they were like 40 something, but
it's pretty close.
Yeah, so they're either in all or almost every state. And if you do this long enough, your inventory is going to be in all those states, which means you have Nexus in pretty much all of those states. Now, that opens you up to, do you or don't you have to collect and pay sales tax? Luckily, things are starting to evolve a little bit where they're making Amazon take care of this. Amazon now requires, in the majority of those states, Amazon has to collect the sales tax. Amazon has to pay the sales tax. So if you're just using Amazon, you don't have to do anything there. That opens the next question. If you're on multiple channels, or let's say selling on your own website on top of Amazon, what do you have to do there? That's where it gets tricky, because every state is different. Some states will basically treat Amazon like their own thing, saying, all right, you have a nexus with Amazon, Amazon takes care of that, but you don't have inventory from your own website in our state, so you don't have to do anything else on top of what Amazon's doing. Some states will say, no, by virtue of selling on Amazon, you personally have nexus here, so we want you to collect and pay for your website as well. So unfortunately, I have to say the answer that everyone hates, that CPAs have to say all the time, is it depends. What I would say is if you're a serious e-commerce seller, you need to talk. There's several businesses now that focus specifically on sales tax. So Peisner is a big one that we send all our clients to. They will do an analysis for you and say, okay, these are your platforms you're on. This is where you're selling. These are what these states say. This is exactly what we believe you should be doing. And that's the best thing I can tell people to do, because it's the Wild West out there in the sales tax world.
For people just getting started, is there a materiality threshold where at a certain point you should start worrying about that, or say reaching out to a company like Peisner?
Yeah, so again, it depends on the state. Some states have higher ones than others. If you're just selling on Amazon, I would not, and you're just getting started, you don't have to worry about it. Amazon overwhelmingly is going to take care of it, and you're not going to be high enough in the other states to have to worry about it. If you're selling on multiple platforms and you're starting to see, I don't know a specific sales number, but you're starting to have some good sales on all your platforms, you need to reach out as early as possible. It's better to catch this early than catch it late, because what someone like Peisner is going to do is say, hey, you've actually had Nexus here for the last 2 years, and what you probably should be doing is going back and saying, hey, I had this, I didn't pay it, here's my money. That's the worst case scenario, because normally sales tax, you're collecting it from the customer and then paying it. So you're not using your own money. If you have to go back 2 years, you're spending all your own money because you never collected it. So my best advice there is talk with them as early as possible and catch it before it's too late.
Josh, I did a deep dive on one of my own brands recently, and I think it was the month of April that I was looking at. And when I looked at my P&L that month, my Amazon fees just seemed high. Higher than what I thought they should have been. So I did a deep dive on everything I was being charged in Amazon. And turns out there are a couple of FBA fees that needed corrected. But I did find that in that particular month, $1,800 had been taken out for sales tax. And so I looked at all of those sales that required sales tax being taken out. And I pulled a inventory report where I saw where all of my inventory was at, to see where I had Nexus. And there was about 30 states in which I have Nexus in, meaning that there's 20 that I don't, and right. Presumably wouldn't have or wouldn't need to pay sales tax there. And so when I looked at it, I think it was like 300 of the $1,800 that, there may be opportunities to save money on sales taxes. And I know that's kind of a very specific and in-depth question, but is the juice worth the squeeze in terms of reaching out to some of these states and applying for, I don't know if you'd call it a waiver, or is that something you're just better off letting Amazon take care of all of it?
So if it's Amazon collecting automatically, you won't have the option. So there's some states that said, we don't care about the seller. We don't care about their nexus. We're treating Amazon as the seller. And if Amazon has a sale in our state, you will collect it and you will pay it. If that's the case, that's actually good news, because Amazon's going to collect that sales tax for you and then pay it for you. So it's nothing coming out of your pocket. You're collecting it from the customer and then paying it. Obviously, can create a competitive disadvantage if your product gets priced a little higher because someone else doesn't have to collect it. But in theory, they should. If the state requires it, every seller has to do it. There's no option. Amazon's going to collect it, going to pay it, and it doesn't matter whether you personally have Nexus or not.
Ken, anything else you want to talk about as it relates to sales tax?
So as it relates to sales tax, I think we hit all of the highlights. What I would like to say is, early on when I first started my business and I got to about 6 months, I had hired a local accountant and went to them for taxes, and I got super deep in a hole because that accountant didn't understand e-commerce. So, and for all the listeners listening, I would just say that early on, try to reach out to, I've been working with Josh and his team, Ron and Chad over there for almost 2 years now. And these guys know exactly what they're doing in terms of e-commerce and online sales. Whereas a kind of a local accountant, that's not to knock a local accountant, a brick and mortar accountant, but reach out to a specialist and because, taxes are complicated, right? Like I solve problems in other areas. Taxes is not one of them. So it was overwhelming for me. So, but when I reached out and found Josh and his team, it was very reassuring. These guys jumped in and said, hey, boom, 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 do this. And it was like a ton of weight lifted off, So I would just say that if you're listening, if this topic is super overwhelming, like it is for me, I'm not an accountant, right? So, but there's specialists out there that can help. So don't let it overwhelm you. Just reach out, find someone that specializes in this. You're good to go.
Ken, just to add to that, it was 3 a.m. on July 15th, the day that all the returns needed to be postmarked, and I was wrapping up my tax return. And I am a CPA, but I'm not super fluent in tax. And Josh, I think in the next year I'm going to get a hold of you and would like to start working with you as well. That was sitting there at 3 a.m., just making sure everything ticked and tied out. I realized that this is something I need to get off of my plate, and I'm probably not doing a great job at it to start with.
No, it's tough. And I think that's exactly right. What you said, Ken, is get someone that specializes in your industry. If you're a real estate investor, get someone that works with a lot of real estate investors. If you're e-commerce, get someone that works with a lot of e-commerce. And on top of their specialty, like we know that our specialty is income taxes. Our specialty is not sales taxes. So when you have specific questions on sales tax, we're going to say, all right, let's consult Peisner. Let's consult TaxJar. Let's consult the people that this is all they do because it's that important and that difficult. So the more specialists you can get in your corner, I think the better.
So Josh, when somebody first starts an e-commerce business, oftentimes they are bootstrapping their earnings and reinvesting everything back into inventory, and they may not take a salary for the first year, the first 2 years. And at some point they need to transition into drawing a salary. And I know that, and I can just speak to a situation of my own where there's a lot of volatility in the market, and I don't know how I'm going to finish out the year. And for a particular brand, say I would like to extract $100,000 out of that business for a salary. But I'm not sure if that's going to happen, and I'm not sure if the earnings will be there. Is there, in terms of just tax efficiency, would there be any gains or disadvantages to, say, putting yourself on salary for $50,000 and then at the end of the year bonusing out at $50,000 as it compares to, say, just $100,000 salary?
Sure. So yeah, and some of this will depend on what type of entity you are. So if you're a sole proprietor or just an LLC, you actually can't pay yourself a salary. You just take what they call distributions, and that you can take as much or as little as you want. There's zero tax impact whatsoever. So, and if you're a sole proprietor, you're an LLC, you're a general partnership, this isn't something you have to worry about. You just have to, you take out money when you want it and don't take money out when you don't want it. Once you become an S-Corp, not only can you take a salary, you have to take a salary. And it has to be what they call what the IRS says is a reasonable salary. And the IRS being the IRS, it's pretty vague what a reasonable salary is, right? There's not a specific X percent of this. So some of it's common sense. If you're making $500,000 a year, you can't pay yourself $5,000 and call it a reasonable salary. What we like to tell people is you have to pay yourself what it would cost to replace you in your role in the business. All right, so kind of think about what you're doing day to day, how many hours you're working per week. And if you said, I want to keep my business, but I don't want to do this work anymore, I'm going to hire someone to replace me. Generally, what would you have to pay someone to have that role? That's what you have to pay yourself. If you want to pay yourself more, you can. It's just the higher the salary, the more taxes you pay. So once you establish what's reasonable, how you pay that out makes no difference. So let's say, go to your example, you say that, all right, 100,000 is reasonable, 100,000 is what I want to pay myself. You could do $50,000, like you said, and then just get to the end of the year and do a bonus for $50,000. There's no tax impact of that. A lot of people say that bonuses are taxed higher. That's not the case. Bonuses, if you work at a job, they'll withhold higher on a bonus because they'll assume it puts you into higher tax brackets, but you don't actually pay higher taxes on that. If you overpaid, you just get it back at the end of the year. So what I'm saying is it makes no difference. You can pay $50,000 now, $50,000 in December as a bonus. We have some clients who literally pay themselves no salary, get to December and say, all right, I need to run this salary, and they run all $100,000 at the end of the year. Whether it's actually paying themselves $100,000 or simply saying, I'm going to run it through payroll and pay the payroll taxes on $100,000, but I didn't actually pay myself a $100,000 salary, which that's a little more advanced strategy. You got to reclass distributions and things like that. But what I'm saying is there's tons of options and there's no impact for how you do it.
So if I'm understanding you correctly, you don't necessarily have to take a paycheck every 2 weeks, which can be a consistent cash flow suck on your business. You can kind of time it to where it may make sense from a cash flow standpoint, as long as, from the IRS's standpoint, they're just looking at how much was taken out in salary throughout the year. Is that right?
Yep, exactly. Okay. They want to make sure you paid yourself a reasonable salary for the course of the year. And they, most importantly, want to make sure you paid the payroll taxes on that. How or when you pay that really makes no difference.
Got it. And one last question that I have for you, and this has been a topic that's come up in a couple masterminds that I've been in, and that is building a warehouse. And I know that that's something that as people grow and have more inventory, that may be something that's a good fit for their business. Now, when I think about this plan, there would be two ways to go about it. One is it could be a business expense and it could be a capital asset on your business's balance sheet. On the flip side, you could set up a separate real estate entity and charge yourself, fair market rent. Have you seen, what are your clients doing when in this situation? Is there a more tax advantageous strategy to build a big project like this?
Yeah, so there's a few options there. I think that mostly it's going to come down to a legal question. Your attorney's probably going to tell you to keep the warehouse in a separate entity, just so if something happens to the warehouse, they can't come after your business for it. From a tax perspective, it's not going to make much difference because they have something that's called the self-rental rules, meaning you can't make or lose money when you're renting to yourself. So you can charge yourself fair market rent, like you said, but if you show a loss, there's certain rules in place that it's not gonna. Basically, you're gonna pay yourself rent on one side, and you're gonna deduct rent on the other side. So it's gonna be a wash, right? You're gonna pay yourself $500 rent over here, claim that $500 of income, and deduct $500 on the other one. The net result is a wash. Okay, so tax-wise, it doesn't matter too much whether you keep it in one business or form it in a separate entity. You're gonna get the same deductions either way. Where the difference is going to come is going to be legally.
I guess one last question. Sorry, Josh, you are a wealth of information. This is awesome. One thing that I know a lot of our listeners run into is, say in their first year of business, they don't make any money. Yep. They may be reporting a loss. And I've heard people say, well, I didn't make any money this year. I'm not going to file a tax return. What would you say to that individual?
I would say file a tax return for your own benefit, because let's say you have a W-2 job, right? And you make $100,000 a year in that W-2 job, and it's your first year in business and you lost $10,000. Those can offset each other. So your $100,000 from your job now becomes $90,000 of taxable income after you deduct that $10,000 loss. So you're paying less taxes. You're saving money on your overall tax return by filing those business taxes.
Awesome. No, that's a message that I think a lot of people need to hear. And I've heard that. I can't tell you the number of times I've heard that is people say, I didn't make any money, or I didn't make that much money, and so I'm not going to file a tax return. And it always seems like that's not the best option, but I wanted to check in with an expert and see if that was in fact not the best option. So Ken, you want to get started with the fire round?
Yeah. So, Josh, at the end of every show, we take everybody through a lightning round. We got 3 quick questions. What is your favorite book?
Yeah, this was a tough one for me because it's hard to narrow it down. I'm going to go with The Wealthy Gardener by John Saforic. Tons of entrepreneurial lessons, building wealth, just anything you can think of is in that book, and it's easy read. It's entertaining.
You know what? Yeah, I'm halfway through that book right now, and I enjoy it. It doesn't bog me down. That's a great book.
Yep.
What are some of your hobbies outside of work?
My biggest one probably I'm a girls' high school tennis coach in the fall, so we're gearing up for that right now. I have 3 kids and 1 foster baby in the house at the moment, so we're plenty busy with those, if you call that a hobby. Yeah, sports, family, that kind of stuff.
Nice. Yeah, I would definitely say 3 or 4 kids, that's a hobby for sure.
Yeah.
Excellent. Okay, last one. What do you think sets apart successful e-commerce entrepreneurs from those who give up, fail, or never get started?
Yeah, I touched on this earlier, but the biggest thing for me is perseverance. If you're going to get into any type of entrepreneurship role, you got to know that you're someone that can stick through obstacles, can look at a problem and just there's a way to solve every problem. If you're someone who just looks at a problem and says, there's nothing I can do, entrepreneurship is probably not going to be for you. You need to look at it and say, man, the sales tax stuff is really difficult. I don't even know where to start, but I can go ask this person, right? There's a lot of people that are going to be overwhelmed just thinking about sales tax, just hearing our conversation here. You need to be someone that says, I need to take action somehow, whether it's just asking someone, whether it's getting started myself and learning and making mistakes. You just got to find a way.
Excellent advice. So Josh, really appreciate you coming on the show, sharing all your knowledge on taxes and accounting. How can people get a hold of you?
Yeah, so they can always go to our website. We have a lot of free information on there they can tap into, cpaonfire.com, or they can reach out to me directly, josh@cpaonfire.com.
Well, Josh, we really appreciate you being a guest on the Firing the Man podcast. Thanks for joining us.
Hey, thanks for having me. It was fun.